Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor, Alonzo Hoyer, social media insurance bro. Back again today to wipe and tap on your head with another ADH wealth solution. Today, we're going to dive deep into, I guess, something that's talked about often in this financial services civil war, which is commission. Because people are like, oh, term life insurance pays a substantially lesser commission than these permanent policies and IULs. Well, if you look at the fact that, yeah, they are going to pay a lower commission because generally you're paying more into it. However, what we're going to look at is dollar for dollar. So, before I continue, hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Explain the commission paid to an insurance agent on a term policy versus a whole life policy versus an IUL if the client pays the exact same premium in each scenario. The premium in this example will be $200 a month. Base this upon what's called street level commission for life insurance agents. Go. Okay, so let's break this down in a street level commission scenario. That's the typical agent commission structure before overrides, bonuses, etc. I'll explain how it plays out if a client pays $200 a month, $2,400 annually into a term policy, a whole life policy, and an indexed universal life. So how street commissions generally work. FYC, first year commission. Agents get the largest check in year one, usually between 70 to 100% of target premium depending on product type. Then there are renewals and trails. Some products pay smaller ongoing renewals after year one, often 2 to 5%. Where it comes from. Commissions are paid by the insurance company out of the expense load built into premiums, not directly out of the client's cash value, though the structure of the policy influences how much can accumulate early on. So right there, ladies and gentlemen, bada bing. Example, $200 a month, $2,400 annual premium. Term life, street level comp, 70 to 90% first year premium. Commission, $2,400 times 90% equals $2,160 in year one. Renewals may be 3 to 5% for a few years. It varies by carrier. Note, since premiums are low compared to permanent products for the same face amount, carriers can afford to pay high upfront commission. Wait, but everybody's saying that you get paid more by selling whole life or IUL than term life. Whole life insurance, street level comp, 50 to 55% of annual premium. Can be lower with participating policies like Mass Mutual Whole Life. Commission, $2,400 times 55% equals $1,320 in year one. Renewals, typically 2 to 3% of the premium for years 2 to 10, sometimes longer. Note, because part of the $200 funds guaranteed cash value plus dividends, less of the premium is available to cover agent compensation up front. 3. Indexed universal life insurance. Street level comp, 90 to 100% of target premium. Important, commissions are only paid fully on the target, not excess overfunding. So when people are talking about overfunding or properly structuring your IUL, they actually get paid less than more. Let's assume $200 a month is set at target. The commissions are $2,400, let's say times 100%. So the agent will get $2,400 in year one. Renewals often 2 to 3% on target premium for years 2 to 10 plus. Notes: if a client overfunds beyond target, say $500 a month into cash value, the agent may get little to no commission on the excess. That money goes straight to growing the client's cash value. Side by side, year one commission on $200 a month. Term, around 90%. Their year one payout is $2,160, and then they have renewals. Renewals are negligible. They're going to be about the same. Whole life, 55% commission. The agent gets $1,320, and their renewals. IUL, 100% on what's called target, means they would get the full $2,400, and 2 to 4% for the remainder. Key takeaways for the client. Their $200 premium doesn't change between products. The agent's commission varies depending on how the product is structured and how much of the premium is available for upfront comp. Overfunded IULs and whole life policies reduce agents' compensation but increase client value. The consumer-friendly designs often pay the advisor less. So that's it, ladies and gentlemen. Stop listening to the bullshit of people who are just trying to get you in a term policy and an investment because they make way more money off of your money being in an investment, because when your money continues to grow and you add the management fee of 1%, that if you make more, 1% becomes more of what you made, and the trails and the expense ratios. Wipe ass, work in progress every day and see success, and stop listening to the bullshit. Salute.